Welcome to our discussion of monetary policy in a time of structural change. The COVID-19 pandemic not only caused one of the most severe economic downturns, but also changed the way people live, work, and spend their leisure time.
In response, the Fed has kept the federal funds range at the zero lower bound and continued to conduct large-scale asset purchases. With inflation remaining high and the recovery in employment remaining slow and uneven, how should the Fed address its dual mandate of maximum employment and price stability in a time of structural change?
To address these questions, we must first analyze trends in GDP growth, labor demand, inflation, financial stability and conditions, and risks surrounding the economic outlook.
The economy has rebounded strongly in the first half of the year as new COVID cases declined due to vaccination. The growth in GDP came mainly from personal consumption expenditures, especially services, which have started to recover from their pandemic lows.
That's true, but as seen on slide 4, we still remain 1.7% below potential GDP, and real personal income, excluding transfers, a proxy for real gross domestic income, has flattened out in recent months.
I agree. Most forecasts expect GDP growth to slow in the second half of the year. Growth mainly depends on the future course of the virus and vaccinations.
As noted by Governor Brainerd, the pandemic continues to cause supply chain bottlenecks and restrain demand for services, weighing on future growth.
As seen on slide 5, service consumption dropped at the beginning of the pandemic, but since the start of 2021, it has contributed 2/3 of the rebound. Although durable goods consumption grew faster, they account for a smaller share.
While that's true, consumption of COVID sensitive services has suffered in recent months due to fears of the Delta variant. This could pose a problem if new strains continue to appear.
In addition, consumer confidence and sentiment indexes have stalled below their pre-pandemic levels, which may restrain future consumption.
I think you're both too gloomy. As noted by President George, household savings remain above their pre-pandemic levels, suggesting that consumers are able to keep spending as we enter the holiday season.
Also, consumer wealth is at its all-time high in relation to income, which usually motivates consumers to spend.
While that is true, growth in real personal income has slowed since the first quarter, reflecting an end of government transfer payments.
As shown on slide 7, investment has rebounded strongly since the beginning of the year, led by non-residential fixed investment. This reflects accommodative financial conditions and the reopening of the economy.
But indicators for future investments, such as new orders for non-defense capital goods, have trended downwards recently. Also, shortages of materials and electronic components have held back businesses' investment in vehicles. Prolonged bottlenecks and uncertainty around the Delta variant may delay investment.
Exactly. As seen on slide 8, residential investment has also been a drag on economic growth. Both housing permits and housing starts have turned down since the middle of the year, likely reflecting material shortages, which are keeping housing prices high.
As seen on slide 9, I expect government spending, such as healthcare and defense, to contribute modestly to growth over the medium term.
But if current congressional negotiations are successful, government spending may increase significantly in the upcoming years. Even if unsuccessful, in the medium term, I expect these headwinds to fade and GDP to converge onto potential.
In the near term, however, I project that restrained service consumption, production bottlenecks, and the persistence of COVID is likely to moderate GDP growth.
Similar to GDP, employment has recovered to 96% of the level projected by the CBO in January 2020. This recovery is mainly due to a strong rebound in service employment as service consumption recovers.
In particular, employment in leisure and hospitality, which was hardest hit by COVID, has recovered vigorously, reflecting pent-up demand for travel and public dining.
That's true, but employment in these sectors has stalled. Furthermore, total employment is still almost 7 million below CBO projections.
As shown on slide 13, the unemployment rate has fallen to levels consistent with past strong recoveries, and the spread between the U3 and U6 rate continues to narrow.
But the current unemployment rate is misleading. The labor force participation rate is unusually low for this point in the recovery. A more realistic labor force participation rate could put the unemployment rate at 7.5%, according to Governor Brainerd.
Women have been especially hard hit by the pandemic because they traditionally assume the role of caretaker of both children and the elderly. As a result, we see the labor force participation rate gender gap remain larger than pre-pandemic, disproportionately affecting mothers of color, according to Melinda Pitts.
Also, senior workers have dropped out because they're especially vulnerable to COVID. Seen on slide 14, the pandemic also widened the gender gap in the employment to population ratio.
Furthermore, less educated individuals who mainly work in services have been especially hard hit. Their employment to population ratio is 6% below their pre-pandemic level, compared with highly educated workers who are only 2% below. This implies that the labor market recovery is uneven and far from the Fed's broad-based and inclusive employment goal.
As seen on slide 15, labor demand has continued to rise as measured by the number of job openings per unemployed worker, which is higher than pre-pandemic. This may also reflect workers' desire to hold out for a better job.
The strong demand may also explain why quiz are above their pre-pandemic levels, especially for leisure and hospitality, which is growing quicker than other sectors.
Looking ahead to slide 16, the labor market continues to heal, as we could see from initial and continuing claims data. Although improvements have slowed recently, both series have reached their lowest level since the pandemic began, indicating that workers have either found jobs or layoffs have declined.
While that is true, employment faces downside risks as production bottlenecks restrain employment in durable goods and fear of COVID restrains services.
As seen on slide 17, the increase in job openings has not led to an increase in real wages. To account for labor force composition, we focus on the Employment Cost Index and the Atlanta Fed Wage Tracker. As noted by Jason Furman, nominal wage growth has not kept up with inflation.
But wages have not declined equally in all sectors. Wages in services, such as leisure and hospitality, have fallen the least as services start to regain their normal share of consumption. This may also explain why the real wages for less educated workers have fallen less than the others.
The decline in real wages could explain the slow improvement in labor force participation. Firms may need to raise nominal wages even further to attract workers they need. However, this could raise the risk of further inflation, as mentioned by Chair Powell.
I don't think that's a danger. As seen on slide 18, productivity has grown faster than real wages in the first half of the year, which should calm fears of a wage price spiral.
Taking into account the risks discussed so far, we expect that as the effects of the pandemic begin to fade, workers will return to the labor force, alleviating labor shortages, especially in services. As with GDP, this transition in employment appears to be slowing, in line with Oken's law.
Inflation has picked up as the economy has recovered. After adjusting for the base effect, headline PCE inflation has risen to 2.9%, and core PCE has risen to 2.7%. Following the same trend, headline CPI inflation has risen to 3.6%, and core CPI has risen to 3.1%.
But inflation is only concentrated in a few sectors, especially for durable goods such as cars, as well as for housing materials.
Looking at inflation expectations, although short-term measures of inflation expectations have risen to almost double the Fed's target, medium-term measures have been roughly stable.
While that's true so far, if inflation remains high, longer-run inflation expectations could become unanchored.
On balance, we expect headline PCE to slowly moderate over the coming year, falling in line with the Fed's flexible average inflation target. We should remain aware of the progress towards alleviating supply chain shortages and their effect on inflation and inflation expectations.
In addition to its dual mandate, the Fed has a third implicit mandate of financial stability. This is commonly broken down into asset valuations, borrowing by non-financial businesses and households, funding risks, and leverage in the financial sector.
As seen on slide 25, stock prices are elevated, judging by the cyclically adjusted price to earnings ratio, currently 60% above its 40-year average. A fall in these assets may depress consumption through the wealth effect.
Slide 26 shows that the corporate debt to GDP ratio is also high compared to historic levels. This can make firms vulnerable to a downturn if firms are unable to pay their debt obligations.
But the interest burden is low, shown through the interest coverage ratio, which is heading above its pre-pandemic levels, reflecting a rise in earnings and stable interest costs.
Also, non-financial short-term debt as a share of total debt has returned to pre-COVID levels, showing that firms are not overly reliant on short-term funding.
In the financial sector, loss absorbing capacity as measured by Tier 1 capital as a share of risk-weighted assets has never been higher. In addition, banks' reliance on short-term wholesale funding is near historical lows. Thus, the financial sector is currently relatively resilient and able to channel savings to investment.
According to Chair Powell, monetary policy affects the economy through financial conditions, which currently support investment. As seen on slide 29, through arbitrage, The low federal funds rate keeps other money market rates low as well.
Longer-term rates are also lower than pre-COVID, but have begun to rise in anticipation of tapering.
Credit spreads are also relatively low. After spiking at the onset of the pandemic, both short and long-term spreads have fallen below their pre-pandemic levels.
Stock indexes have risen and the exchange rate has fallen since the beginning of the recovery, supporting growth.
Although nominal short-term rates continue to be near zero, what matters are real short-term rates compared with the short-run R-star. By this measure, they've only been accommodative since June of 2021, according to the New York Fed's DSGE model.
But that accommodation may be temporary, since short-run R-star has flattened due to the Delta variant.
The Fed has also provided accommodation through its balance sheet policy, purchasing at least $80 billion in treasuries and $40 billion in mortgage-backed securities per month for over a year. Continuing this extraordinary accommodation would overstimulate the economy as COVID wanes. I believe that the Fed should begin tapering no later than the fourth quarter of this year, which would give them time to begin liftoff in 2022.
I agree. According to Lord Logan, the Fed initiated large-scale asset purchases to improve the functioning of financial markets, which are now functioning properly, reducing the need for continued purchases.
I disagree. According to University of Washington projections, the path of the Delta variant is uncertain and could restrain the economy for longer than expected. We should delay tapering until the effects of the recovery have taken hold and COVID has largely faded, which I expect to be in early 2022.
Exactly. As noted by Governor Brainerd, the Fed has sometimes removed accommodation too soon. The Fed should demonstrate that it'll tolerate higher inflation long enough to reach its average inflation target of 2%. The Fed should not specify a specific liftoff date until economic data confirms the recovery.
I'd like to point out that the flattening of the Phillips curve now puts greater weight on inflation expectations. With inflation high for 6 months, inflation expectations have already doubled the Fed's target.
While that's true of short-run expectations, as previously seen on slide 22, 5-year inflation expectations and inflation compensation have been stable throughout 2021. Former Chair Yellen emphasizes that the Fed targets inflation in the medium term, not the short term.
But supply disruptions could keep inflation high for some time, which may anchor even longer run inflation expectations. If this occurs, the Fed would need to tighten monetary policy rapidly, threatening financial stability.
But the Fed cannot solve supply chain disruptions, which will likely fade with COVID. Also, according to Veronica Guerreri, monetary stimulus will raise the relative wages in the service sector and accelerate the growth in service production to a more normal share.
That's true. Also, the danger that additional accommodation would de-anchor inflation expectations is lower now than before because the Phillips curve has flattened. To help maintain credibility, I believe the Fed should improve communication by discussing specific indicators that guided the FOMC in arriving at their economic outlook for each particular meeting.
But the Fed has repeatedly said that it does not want to be tied to specific indicators or a rules-based approach. Wouldn't your recommendation contradict that?
Not really. My recommendation is that the Fed should outline the indicators that helped guide its outlook, not tie itself to any specific indicators for all future decisions. Furthermore, the Fed should continue to emphasize that tapering does not signal a liftoff of its policy rate, so not to tighten monetary policy through the signaling channel.
In addition, it is important that the Fed remain forward-looking. Under our policy of tapering in early 2022 and lifting off in 2023, we project that over the next 4 quarters, GDP growth will average 3.4%, the unemployment rate will average 4.6%, and PCE inflation will average 3.9%. Our forecast is based on the longer than expected impact of the Delta variant on the economy.
Based on our discussion, we will consider 2 policy options. A, taper in the fourth quarter of 2021 and announce the intention to start liftoff in the middle of 2022. B, taper in the first quarter of 2022, postpone the announcement of liftoff until the effects of the pandemic are more clear, and provide post-meeting analysis of the indicators that guided the Fed in forming their economic outlook. Our challenge is to conduct monetary policy in a time of structural change. Therefore, we recommend policy option B. To accompany the additional communication, the FOMC should include the following clarification. Quote, the indicators discussed in this statement may or may not guide future FOMC deliberations, outlook, or decisions. End quote. Thank you.